Today, folks, I'm going to explain to you why I'm no longer buying stocks. I've been very fortunate, very strategic in my plan to try and outperform the market during this bear market trend, as obviously I don't short the market. I have to be very strategic as we're going to analyze the data on why we might not be seeing the end of this bear market cycle. There's a lot of horrifying data that has been recently emerging, but there's also a lot of good data we're also going to be analyzing. And then I'm going to share with you the strategy and the very fortunate luck I've had thus far, because woo baby, this is not financial advice, but damn it have I been lucky, because you go back a month ago on my channel here, guys, and I was making videos saying how I'm investing $10,000. Hey, I invested 20 grand. I went so aggressive here, you know, inflation's dead, all that stuff. And that was right at the bottom of this year's market, though that might not be the bottom moving forward. It's just a very good time to start picking up. And I'm going to explain to you toward the end of this video, the strategy and how I'm kind of playing these charts, because even the TSX, guys, what a hell of a buying opportunity it was through October. But firstly, oh man, let's talk about the data here, because this isn't good going into a holiday season. Take a look at credit card debt. This is horrifying hedge funds. This is horrifying major institutional investors, but damn it, credit card spending going into the holidays hit a recent all-time high in the same moment that savings rates have hit a low we haven't seen in a decade plus. Like the last time savings rates went this low was back between 2005 and 2008. And in this holiday period where I've seen a lot of people at the malls, there's a good chance they're buying a lot less, which isn't going to bode well for Q4 earnings that we're going to see coming out of these companies like Apple. For example, if you order an iPhone today, you're not getting it to January because they've had so many problems with their factories. There's a lot of skewed data that says, hey guys, this might not be the most exciting Q3, especially when you look at budgets and ad spending going on with big companies. They've all reduced it. They're all continuing to lay off. And this leads into a Fed pivot here as well, guys. I mean, inevitably the Fed's going to pivot. They're going to stop raising rates. But the scary thing about that is if you look at any historical crash in the market, the crash came after the Fed pivoted, not before. You can see it in 08, you can see it during the dot-com bubble, and even back in like the 70s and 80s. So I don't know, you can't really use past data to represent future forward-looking information, but this is very intriguing, and it all sits on that very negative, sink your gut kind of feeling. But let me show you the good side of the market, because there's nothing saying the market can't continue to rally from here. The market is pure fugazi, guys. It doesn't trade off fundamentals like it used to, and we've all seen this data that recently came out that the fund managers scream capitulation as cash levels rise to the highest level in 21 years, Bank of America says. Fund managers have taken their cash position to the highest level in 21 years, according to the long-running monthly survey of portfolio managers. The survey found the average cash level was 6.3% in October, up 6.1% in September, and well above the long-term average of 4.8%. I mean, a net 72% expect a weaker economy in the next 12 months, and 91% say earnings are unlikely to rise 10% or more in the next year. So institutional, money is just parked in cash, likely bonds, GIC, cash equivalent of investments that, they can sideline for the time being. And that's something that if that money decides to come back into equities, it doesn't matter how bad earnings are, the market could rally because, again, it's pure fugazi. It's not trading off fundamentals here, right? But we've talked about inflation being completely dead. Inflation is based off a 12-month trailing period. I do not see inflation going back to where it was, guys. I honestly think anytime we hear about inflation now, it's just going to continue to downtrend, and it's going to fall off a cliff coming into February, March, and later into the spring of next year, because all commodities have completely crashed at this point. Commodities are what drive inflation. The cost of goods, guys. Gasoline is continuing to find a nice new base here. It's leveled off pretty dramatically. Steel, aluminum, all these things used to make consumer packaged goods fallen off a cliff here. Even wheat has completely collapsed. The geopolitical events are no longer driving inflation. Gross domestic product, people spending, ironically, heading into the holidays here, the past quarters have looked pretty good. For as long as gross domestic product keeps going up, we're not really in a recession. There's no true recession yet, but obviously that could change coming into Q1 of 2023. And the last little bit of data that I just find so utterly unusual is that when the US dollar drops, the market rallies. You take a look at the last month of the US dollar, and it's done nothing but go down as the markets have gone up. Taking a look at the last 6 months here, guys, you'll see for as long as the market went down all year, the US dollar was rallying pretty aggressively. There's almost a one-for-one correlation here that I don't fully understand, but it's something to pay attention to, because it's likely this trend will continue to look the same. If the dollar starts to rally back, we're very likely to see the stock market start to go down. So how am I implementing a strategy to continue to outperform the market? It's something that I want to continue to try and do, and I can only really do it through buying, because I don't do options. I'm not short playing the market. I'm just trying to strategically implement heavier periods of buying, because obviously if you're buying the rallies in the market back, if you get caught up in the hype, you're going to get devastated even more, and you're not going to see green out of those buys likely for a little while. I mean, I don't know if the market's going to continue to rally up, but if it drops from here and you've been buying these peaks, man, you're still feeling a hell of a lot of pain. But if you were able to buy the bottoms, guys, the down periods don't feel as bad. And when the market rallies back, even back from July, guys, you're still seeing a lot of green, right? So this is why when the market starts to drop aggressively, there's a lot of fear. That's when I'm going to be most, intense on my buying, because in October, I invested like 6 to 8% of my entire portfolio from cash into these equities, right? And same with the TSX. Like, this just isn't a fun time to be buying them now. The market's come back so much. The dividend yields have fallen off pretty aggressively. And I'm just like, why? Why would I want to buy here? So in the meantime, I've just got all my stocks set up on a drip. They'll continue to cost average. So no matter what, if the market continues to rally from here, I'll still be buying the rally up, just not as aggressively. But then again, if it does start to pivot, we start seeing more downside, then I'll be more aggressive with my own cash, not the reinvested dividends. So it'll be neat to see how this does moving forward. But I did talk about my portfolio yesterday hitting an all-time high just from cost averaging, not on a percentage basis, sitting around $392,000. Since I pivoted my portfolio, I am now down only 1.6% here. But if I was going to make a bet, if you are looking for a place of stability in your portfolio, I made a very bold bet at the beginning of this year that VYM and dividend stocks would outperform and offer a place of security and stability, because that's where investors and institutional money has currently been running. You look at tickers like VYM, the Vanguard High Dividend Yield ETF, which over the last year, guys, is actually green, and it rallied back super aggressively from the bottom. Like, this is nuts. But it's not a surprise when you take a look at the stocks that are held in here, like ExxonMobil, because its market cap has come back so aggressively, and this is a market cap based weighted ETF. It now sits the #1 top holding, making up maybe about 3.3% of the entire ETF, next to Johnson & Johnson, JP Morgan, Chevron. So a lot of oil kind of basing this in, and I think this is going to continue to be the trend with these dividend ETFs, because again, most of them giving you exposure to energy, and a lot of the sectors like healthcare and places of stability. You can see, even though gas prices have rolled back off to where they were in 2021, that is still historically way higher than it has been in the past. So oil, I think, is what's going to cushion the economy, because even though we're seeing mass layoffs across the board with tech companies, we're not really seeing it when you're talking about the retailers. Like, there's a demand shortage in retail. There's a demand shortage in energy. Like, there's a lot of sectors that are hiring super aggressively right now, which should cushion some of the blow when we're seeing the jobs reports come out from the Federal Reserve here. So that's just something to pay attention to, guys. And like I said, I'm just going to be sitting on my hands for right now when it comes to investing my own cash. The market's still rallying as I'm making this video, and I want to pass the question off to you. Where do you think the market's going to go? I don't know. I'm not trading off of it. I'm just trying to be very cautious and strategic with my cash, because I've got enough money invested already that, again, if the market rallies, I'm fine. If the market drops, I'm fine, because I have cash. So in the meantime, cash is what I'm going to focus on for the next few months until I see what the market conditions look like. But stay cool, stay awesome, and I'll catch you in the next one.